Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing ZIM stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ZIM is one of the largest shipping companies in the world with 118 vessels, and currently 97% of those ships are being used. The way ZIM makes money is it leases out ships to companies that need to transport stuff across the ocean. For example, they recently agreed to lease 15 vessels to Seaspan Corp. That company will transport LNG across the ocean. LNG stands for liquefied natural gas. Liquefied natural gas is natural gas that has been cooled down to a liquid state. It is cooled down to negative 260 degrees Fahrenheit for easier shipping and storage. LNG is 600 times smaller than its volume before it is cooled down. The company is headquartered in Haifa, Israel, and was founded in 1945. They also have headquarters in Virginia. The ticker trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 8 billion market cap. They're trading at $67 a share, and they have 120 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. If you sum their 2018, 2019, and 2020 free cash flow, and then triple that, you're still well below their 2021 number, almost $5 billion in 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also the highest ever in 2021 at $4.6 billion. Revenue is a sales for the company, and that's almost $11 billion in 2021. It's pretty close to the sum of 2018, 2019, and 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is their cost of revenue. These are all the expenses directly related to generating the revenue. The cost to maintain the ships, the cost of insurance, the cost of repairs, also docking the ship between voyages. That's all part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. Under $1 billion in 2020, over $6 billion in 2021. Below that is our operating expenses. This includes payroll for support functions. Gross profit minus operating expenses gives you your operating income, close to $6 billion in 2021. They spent $169 million of interest on their debt, which is a little more than 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example of this is the gain or loss on the sale of an asset. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income, which is the highest ever by far in 2021 at $4.6 billion. This is the company's income statement from their annual report. They generated $10.7 billion in 2021. Most of that was from income from voyages. Here's a breakdown of their income by location, where their ships travel. $5.3 billion in the Pacific, $1.3 billion across Suez. That's the Suez Canal. Almost $1 billion in the Atlantic Ocean. Intra-Asia, $1.7 billion. Latin America, $500 million. And $1 billion of other. A majority of that is from demurrage charges. These are the fees you have to pay when it takes a long time to unload a ship. Sometimes there's delays due to customs. Their gross profit in 2021 was $6.1 billion. Their gross margins are 57%. That's gross profit over revenue, which is better than their industry of 52%. But their net margins are 43%, which are a lot better than their industry. Their main operating expense is general and administrative, $268 million. According to their annual report, they spent less interest on their debt in 2021 compared to 2020. In Yahoo Finance, it looked like they paid more interest on their debt. Sometimes Yahoo Finance combines numbers. If you want to get the true story, you should look at the company's financials. Their earnings per share in 2020 was $5.18. That went up to $40 in 2021. That is just unbelievable growth. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And of course, that was the biggest in 2021, close to $6 billion. Then you have CapEx, investments in property, plant, and equipment. Pretty much all that CapEx is when they acquire vessels. They spent a lot in 2021, over $1 billion. And it looks like that CapEx investment paid off because they're generating lots of cash flow. Operating cash flow minus CapEx gives you your free cash flow. And that was huge in 2021, close to $5 billion. They paid down a lot of debt in 2021, $1.2 billion. And they paid an amazing dividend also in 2021. I'll show you that later. This is the operating and investing sections from the statement of cash flows. Operating cash flow converts net income into cash. So even though they reported a $4.6 billion accounting profit, they generated nearly $6 billion of cash flow because you have to adjust for the non-cash items on the income statement. In their investing section, they spent $1 billion in CapEx. It looks like they invested $2 billion in short-term liquid investments. So in the investing section, they had a cash outflow of $3.3 billion. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And you can see it was pretty steady since 2015, but at the end of 2020, it really took off. Same thing with their operating cash flow. This is their financing section from their statement of cash flows. They paid down $1.2 billion of debt. They paid out over $500 million in dividends. They didn't pay any in 2019 or 2020. They had a cash outflow of $1.7 billion in their financing section. This is the equity section on their 12/31 balance sheet. They have $4.6 billion of equity. They raised $2 billion from selling their business, and they profited $2.6 billion from running their business. Let's look at the capital structure. $4.6 billion of equity, $3.3 billion of debt. They're 58% equity, 42% debt. And they could pay off all the debt with the cash on their balance sheet and still have $365 million of cash left over. This blue line is their equity balance since 2015. And you can see it was negative for a while. And then at the end of 2020, everything really came together for this company. And their cash balance is going up at a similar rate, while their debt balance is getting lower. I gave them a whack of 12%, which is higher than Finbox, because this is a really cyclical industry, so I wanted to keep it conservative, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $15 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $19 billion. We divide that by 120 million shares. And we get a calculated stock price of 160. They're trading at 67, so they're trading at a 58% discount. It's a buy according to the model. Their revenue is projected to hit $8.8 billion in 2024. So I decreased their revenue 6.5% a year to hit that $8.8 billion. And then I decreased it again 6.5% into 2025. That's how I got their future revenue estimates. They convert 30% of their revenue into free cash flow, so I multiplied their future revenue estimates by 30%. That's how I got their future free cash flows. The website Simply Wall Street is even higher than me. They're at 186. They're saying it's 62% undervalued. 4 analysts priced this stock, and the average is 82, the lowest 53, the high is 120. This is where the stock has been trading since it IPO'd, so it's pretty much only gone up. It has regressed a little the past few weeks, but it's still trading well above its IPO price. Since this company IPO'd, the S&P 500 is up 23%, while this stock is up 460%. It was up 600% at one point. They paid a $17 dividend in the first quarter. If you annualize that, it's close to a 100% dividend yield. To calculate their dividend yield of 15%, I use their December dividend. Multiply $2.50 by 4, that's $10. Take that number and divide by the stock price. They could easily afford that. It's only 24% of their free cash flow. The reason they paid $17 is because they had so much extra cash. This is directly from the company's website, so it is correct in Yahoo Finance. Because I was thinking 17 might be wrong. It just seems crazy generous for the company to give such a big dividend. Their yield is close to 28%. The projection is for the yield to come down to about 5.5% by the end of 2024. The stock is up 170% in the past 52 weeks, while the S&P is up 11.5%. The 52-week low is 25, the high is 91. And the stock is trading between its 50-day and 200-day moving average. Over 6 million shares are traded each day on this stock. Of the 120 million shares outstanding, 80 million are on float, 38% are held by institutions, and over 6% of the shares are shorted. They currently employ 4,400 people. If you invested $10,000 into this company when they started trading and reinvested the dividends, you'd have $79,000 today. That's a 700% total return. 39% of the company is held by institutions, 28% by the general public, 26% by private companies, 6% by public companies, and 1.3% by insiders. Their largest shareholder is Cord Investments. This is a British company. They own 26% of the stock. Danos owns 6%. They're another shipping company. Acadian, an Israeli investing company, owns 2.5%, then Deutsche Bank. Let's look at their financial ratios. These are just unbelievable numbers. A PE below 2, that's stock price over earnings per share. A price to sales below 1, that's stock price over sales per share. And a price to book of 1.8, stock price over book value per share. And their price to free cash flow is 1.6. With ratios like this, it's like you're taking no risk investing in this company. Let's look at their non-current assets. The value of their vessels after depreciation is $3 billion. The containers and other equipment is $1.4 billion. 69 million of other intangibles. That includes 12 million of computer systems and communication equipment and 57 million of property and equipment. They have 74 million of intangible assets. That includes 6.3 million of goodwill. Goodwill is a premium you pay when you acquire another company. 66 million of software and 1.6 million of other. They invested 12 million into other companies. 169 million of other investments. That includes 163 million of debt securities, 2.3 million of financial assets, and 4 million of other. They have 107 million of receivables. This is how much money is owed to them, and 2.4 million of deferred tax assets. This should help reduce their taxes in the future. They owe 2.2 billion on their ships. Most of their ships are owned by another company and they're leasing them. They owe 121 million on loans, 66 million of employee benefits, and 121 million of deferred tax liabilities. This should increase their taxes in the future. Their return on invested capital is over 100%. They can cover their interest payments 34 times with their operating income. Their ROE is over 100%. It's not that common to see ROE and ROIC over 100%. Their current ratio and quick ratio are both 1.8. Let's look at their current assets. 119 million of inventory, 1.3 billion of receivables. This is how much money others owe them. 2.1 billion of investments. Most of that is bank deposits of 2.1 billion. And they have 1.5 billion of cash. Let's look at their current liabilities. 1.1 billion of payables. This is how much money they owe others. 28 million of provisions. Provisions are cash the company sets aside for future potential losses. 618 million of contract liabilities. They owe 900 million on their leases. This is what's owed within the next 12 months since it's in the current section. If it's in the non-current section, it's owed beyond 12 months. And they owe 131 million on loans. In 2021, they generated 5 billion of cash flow. They have 2.3 billion of working capital, and they paid out 1.2 billion of dividend payments. So the company's really well capitalized. They have over 6 billion of funding. The best way to look at ratios is to compare them to companies in the same industry. There are 34 companies in the same industry as ZIM, and if ZIM has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in every category except price to book. They invest the most in CapEx. They're better than average in debt to equity ratio. They pay an extremely high dividend. They generate more free cash flow than every other company combined. They're the largest company on this list. Look at their price to earnings and price to free cash flow. Look how much better it is than average. Only two things can happen. The stock will go up a lot, or the company will start making less money, or possibly both. But these ratios are just unbelievable. They generate more revenue than the next 5 or 6 companies combined. Their 3-year annual revenue growth rate is the highest. They have the highest ROA and the highest ROE. So to summarize, I have them trading at a 58% discount. And if you were smart enough to get into this stock in 2020, you're probably extremely happy because you're getting paid really well, that huge dividend. Only the sky is the limit with this company. Their growth is phenomenal. But you do have to remember the shipping industry is very cyclical. So if shipping rates decline a lot, that will really affect this company. But as of now, they're easily the best shipping company. I rank their free cash flows revenue ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.